welcome to the 103rd episode of the Veritas fact-finding series. And this morning, I'm joined by my good friend, Andrew Grunda. Good morning, Andrew.
Good morning, Anthony.
Surfacing facts and revealing truths is a never-ending quest for us at Veritas. In each episode of our fact-finding series, we go on the ground to speak to industry professionals in an unscripted, candid, live video format to discover how we can make better investment decisions. In this series, and with everything we do, we believe the facts empower investors, and that better information leads to better investment decisions. By way of background, my name is Anthony Scilipoti, and I'm the president and CEO of Veritas, which is an independent equity research firm based in Toronto, Canada, and I'm proud to say celebrating now 22 years being 100% employee-owned and operated. Just a quick disclaimer here, this broadcast is not to be taken as investment advice, and participants or employees of the Veritas group of companies may own securities discussed in this broadcast. While we love all our guests, and Andrew, of course, in particular, this session may contain forward-looking statements, investment opinions, and comments that we do not agree with at all. Now, I don't expect too much of that to happen with Andrew. But let me just give you a little bit of background on Andrew. He is involved in studies related to local government finance, financial operations and policy, and long-term infrastructure planning. Think about it this way: when a local municipality needs to make a decision related to infrastructure, make a decision related to school board and infrastructure associated with that, they'll speak to Andrew and his company to discuss the economics of the transaction, of the approval process that needs to take place. But I'm going to let him talk a little bit more about that. He leads development application approval process, user fee studies, striving to provide municipalities with a cost recovery user fees of the Planning Act, Municipal Act, and Building Code Act mandate services. Municipalities use these studies to address the increased cost justification for user fees as required under the Building Code Statute Law Amendment Act. He authors many studies on matters relating to Development Charges Act, full cost recovery, water, wastewater, financial plans, all the drinking water. We're going on the ground here with a group of economists. Andrew himself also an MBA and has his CMA. So he's a fellow accountant like myself, and just an all-around great guy. Andrew, thanks for joining us this morning and sharing your thoughts.
Thanks, Anthony. I'm pleased to be here.
So before we get into, we're going to discuss, obviously, CMHC said we need 3 million new homes. We had Ayord Alawalia from CMHC, their deputy chief economist, tell us in their study. And of course, Doug Ford has just issued, and it's reached, been approved now, Bill 23. So we'll go into the particulars of that, the implications, and what we can expect as we move forward over the coming year. But before we do that, Andrew, why don't you tell us about yourself? Why do you do what you do? How did you get to be the principal at Watson Associates?
Thanks, Anthony. Yeah, it's kind of interestingly, the work we do is fairly niche, and so kind of came into it sort of not intentionally initially. Finished my undergrad work, had a real interest in business, finance, economics, and politics. Came out of school, started working at municipal finance departments, and then came upon this opportunity to join this economic consulting firm that specialized in the municipal government environment. And that was Watson Associates Economists Ltd. So I started there back in the mid-90s, and I always found the work really interesting. Pretty small firm, so pretty dynamic, lots of interesting studies that we were confronted with. And so I started working there in the mid-90s, worked my way up to a partner in 2002, and then became the principal of the firm in 2012. And we've grown to a firm of about 35 individuals now. We just celebrated our 40th year in operation. And the firm has really grown over that period, where when I first started, it was largely a municipal finance focused firm, particularly on development charges, which I know is something we'll talk a fair bit about today. But it's really evolved beyond that now, where we have sort of three distinct groups. My group that I work in with some of my other partners in the municipal finance area still is about 2/3 of our overall operation, looking at developing fiscal policy strategies for our municipal and conservation authority clients, addressing things like alternative revenue sources, fiscal impacts, and a big topic for municipalities now, that is asset management and how to pay for those infrastructure deficit costs. We also have a large area in the organization on demographics and land economics, so looking at development market needs, demographic forecasting, growth management studies. So that's a large growing area, also impacted by Bill 23. And our education group, which does similar types of work we do for municipalities, but for school boards, helping them plan with accommodation and enrollment reviews and the associated facility requirements and funding mechanisms.
Okay, Andrew, there's a lot to unpack there. You touched a number of hot button issues that I'm excited to talk about. Let's get right into it. Tell us about this new Bill 23. How is it structured? And what do you expect?
Sure, and so maybe in doing that, Anthony, I'll put maybe some context around this. So there's been quite a bit of movement in the province around housing. And this largely came out of the provincial government's More Homes, More Choice plan that was initially started and then followed up by the More Homes Built Faster working group and the associated policy work that came out of that. And so it has been a continuum. This is just the most recent legislative iteration from what we've seen, and largely what it's seeking to respond to are the challenges that we're seeing principally in Ontario with respect to housing and housing affordability. And to provide some context with this, we had a really interesting lunch and learn session here at the firm about a week ago with one of my colleagues, Eric Carbonen, and he works in our demographics and land economics group. And he was sort of, putting into context, some of these supply and demand issues and impacts on affordability. And so to sort of put this in some context, I thought I'd review some of that for the purpose of the discussion today. So, what we're seeing in Ontario obviously is fairly strong population growth, and that growth, again, I think what's important to the listeners here today as well is that while there's a significant amount of growth in the GTA and the greater Golden Horseshoe area, this legislation also impacts all municipalities in the province. And so there's 444 municipalities across this province who all have to work under the same legislative framework and the same legislative rules. And so while there may be strong underlying economies and strong underlying housing networks in the GTA area, there's pretty significant challenges, especially around funding growth and infrastructure growth in some of these more far-reaching communities. And so with this strong population growth that we've seen, it hasn't just been confined to the greater Golden Horseshoe area. Some of that is now expanded outside, as we saw through COVID with individuals moving towards remote work environments, now having a larger geographic expanse, not having to commute into the office every day. And so we've seen a greater amount of growth pressures outside of that greater Golden Horseshoe area. And so the latest growth plan estimates from the province and in their Ministry of Finance projections are expecting to see that we're going to add another 5 million people in the province to 2046. Just in some historic context, between 1991 and 2016, we've grown at an annual population rate of about 1.4% a year. And that's projected to stay relatively strong at about 1.2% out to 2041. And a big reason why we have this strong population requirement is because of the underlying aging population demographic that we have, the baby boom generation, the implications that has on the labor force, and making sure that we're bringing in a strong amount of immigration, particularly at the younger age demographic, that can support our economy and support those jobs that are being transitioned out of the workforce. And so that is, another component that's adding to the demand is that you have this increase in population fueled by strong immigration, particularly strong immigration at the younger age demographic, which are in their what's called their household formation years. You also have that demand coupled by the millennial age demographic as well, that are now moving into their predominant household formation years as well. And then what's also adding fuel to that demand is not just the permanent resident immigration, but also the non-permanent resident immigration. So this is due to the changes in the foreign worker program, the international students that are generally in this age demographic of 15 to 34, and place a strong demand on rental housing. So we're seeing quite a bit of demand in respect to that population, fueled by, again, demographics and by immigration. And so why has this had an increase in terms of impacts of housing affordability as well? Is that when you look at the increase in demand for housing, and you look at that relative to increase in wages, what we've seen is that between 1996 and 2021, that in the province annually for single detached housing, that's increased at a rate of about 6% annually. And during that same period, average market rents have increased at about 3% annually over that period. But when you look at average household income, it's only increased at about 3%. So what we're seeing is this outpacing, and that's even more evident when you look at more recent years, between 2016 and 2021, where single detached housing prices have increased at about 6%, average market rates at about 5%, but over that same period, annual household income in the province only increased at about 3.5%. Right, so we're starting to see this imbalance in terms of the ability, not only from an affordable perspective of home ownership, but also from a rental perspective as well. And so with this, tremendous amount of demand, the question becomes, why is there not sufficient supply? And this seems to be the overall consensus of have a supply constraint. And so, a big part of what is leading to that is the underlying economics around bringing those housing units to market, given where we are currently with labor shortages, with the underlying issues we have around the labor market, around construction in terms of the availability, but also the experience of builders and developers that are available to undertake these projects, particularly high density projects. We're obviously seeing cost increases related to that labor shortage, but also related to supply chain disruptions, inflationary pressures. For some context, what we've seen is based on some underlying information that construction costs since 2017 have increased by about 65% over that period of time. And so you factor in, those constraints to supply, the implication that has on construction costs, and now factor in, the higher interest rates and the implication of the carrying cost to homeowners. And also the potential implications on financing to builders with respect to this. And that's why, in part, we're seeing this limit in terms of the amount of supply. And so, with that picture, again, a relatively strong demand picture, which is positive, but making sure that we can accommodate that anticipated demand to make sure we have a strong labor market and therefore a strong economy is important. And so the province has looked at this and then they've developed their plan in recognition of it to say, we have a real crisis here. We need to bring about 1.5 million more homes to the province in the next 10 years. And so to do that, in Ontario's plan, what they're doing is they're as I mentioned, identifying the need for about 1.5 million more homes over the next 10 years. And that comes out of the Smart Prosperity Institute report of August of 2022. And it recognizes that we do have this need for a broader range of housing, particularly to address the need for this attainable housing to support those demands. And that need for this broader range of housing is not new to municipalities. This is something that they're required to consider as part of preparing their long-term planning official plans and strategies in conformance with something called the provincial policy statement. And when we look at unpacking that number, that 1.5 million, what it suggests is that of that 1.5 million in additional homes, about a third of it is required immediately to deal with the shortage in housing that we currently have relative to current demands today. And the other 2/3 of that is generally being provided to address that increase, the additional 5 million that's been identified, as I referred to earlier, out to 2041. And when we look at within that plan, where is it targeted to be located? Well, not surprisingly, it's largely targeted to be located in the greater Golden Horseshoe area. And that represents about 2/3 of that total target allocated to that geography. And the way the province is going about establishing this within its plan is to have something that's referred to as municipal housing targets, where what they've established is for the 29 largest Ontario municipalities, they're asking them to prepare something referred to as housing pledges. And this will have details on how they will sort of enable and support housing development through providing the appropriate planning, the timely approvals, and the associated infrastructure to be able to accommodate them. So one question that we commonly hear from with respect to our clients is the ability for the province as a whole to be able to achieve that level of output over the next 10 years. So again, if we're talking about 1.5 million homes over the next 10 years, and we're looking at the need for roughly about 150,000 building permits or completions every year to be able to facilitate that on average. And when we look at the longer history of 2001 to 2022, building permits in the province have averaged about 80,000 a year. And if you look at more recent history from 2020 to current, that's increased. It's increased to just over 100,000, about 103,000 annually. But to be able to achieve that level of output that the province's plan is suggesting is going to require about a 50% increase in the ability to process that level of development. And that proves some real challenging environments for municipalities, right? And there's a few challenges there, I think. One is, first of all, these housing pledges are what I would more characterize as aspirational targets. So municipalities in the province are required to prepare what's referred to as official plan and projections about how they plan to build over the long term. And these aspirational targets are not intended to replace those projections. So while some municipalities will seek to develop these pledges to identify how they can accommodate the additional growth over and above what their official plan projections may already designate, it is not a requirement that they be currently anyway established within those official plans. And the official plan is important, right? Because that is the underlying context to the municipality in terms of how they're going to grow, what levels of service they're going to provide, how they're going to provide that to their community, where it will be provided, right? It's sort of the overall plan for the organization and the community as a whole. And so what is also going to prove challenging then is making sure that we have sufficient designated land supply, but also supported with infrastructure, right? So these developments can't occur and they can't move through the development process unless there is sufficient infrastructure there, largely in the form of hard infrastructure, which tends to precede approvals, like the water and sewer infrastructure, the major transportation networks, and so forth. So that's going to prove a challenge to move that forward in a timely way, if not already provided, particularly in areas that may be outside of their official plan projections already, right? So, one thing that I know some of my clients are faced with is, as you may have heard, the province is using something referred to as ministry zoning orders, MZOs, where they're designating lands for development that may be outside of urban areas or in different locations than official plans would suggest. And so municipalities have to figure out how to provide the associated infrastructure to service that. And so that's going to be a challenge. The other challenge, which is significant, especially around being able to increase the amount of building permit activity by 50% annually, is I do a lot of work with municipalities on their development approvals fees. So this is the planning application fees that allow the lands to be developed and ultimately constructed on through building permit activities and occupancies. And one of the things that I see with a lot of my clients is, with this aging workforce and retirements, them being able to recruit and retain, maybe even more so importantly, the appropriate individuals with the experience to process those applications in a timely manner is really a choke point in municipalities. And so that is definitely a challenge that municipalities are going to have, being able to achieve that level of output. And then again, I think just the production of the units themselves, as I mentioned earlier, the cost pressures on the development industry, whether it's supply chain, whether it's availability of construction labor and the experience of labor to undertake that, their cost of financing and so forth. So I think these are aspects that are really going to impact the province's overall plan that it's seeking to achieve. And so that's sort of more overarching. And then Bill 23 is just, again, sort of one component, the most recent component, which is relatively significant, that's seeking to put that plan into place. It has its own challenges specifically geared towards it. So again, I'd be happy to go through that or pause there if you had any questions or thoughts.
Yeah, look, as everyone can tell, Andrew and I have trained for triathlons. Andrew's completed 3 Ironmans, so you can just see the level of discipline and the amount of detail that the organization goes through, and just how complex. It's amazing. We read stories on the front cover of the Globe. Oh, we're going to expand the green belt. We're going to produce this many homes. And Andrew and I will have a discussion. He said, well, how's the water going to get there? How are we going to have cars get there? What about the subways? What about the electricity? What about the waste? There's so much that goes into just saying, hey, we'll just put in this many plans. It's amazing that this many new housing units. It's amazing how the one point you made, conceptually, we can see that we have an aging demographic. We've seen cost pressures. So especially in the construction industry, the average age, and we've had at our various real estate conferences, we've had the head of LIUNA speak to us about the demographics in construction. We're talking average ages in the construction industry with the various key trades in the 50s and some in the upper 50s. So the skilled labor that we need to actually complete these homes, where is it going to come from? And then I hadn't thought about the other side. You need someone just as experienced to say, yes, that's a good plan. Build that infrastructure, or build that housing unit. And those individuals are retiring too. And we're not replacing them with skilled individuals. So we have a real issue. But maybe what we can kind of zone in on now is let's look at the specifics of Bill 23, and just let's walk us through now with the research your organization has done. You see where the limitations are. Now you see this new plan, and obviously you've gone through the challenges. How do you see this playing out? Are we going to get to a point where we have some affordability? Because clearly, I think we've seen various economists speak that today, even though house prices have come down with the change in interest rates, housing affordability is as bad as it's been since the last time we had a real housing correction, which was back in 1991. So maybe you could walk us through that perspective.
Sure. Yeah. And so again, to Jen, in terms of this overall plan of the province, right? So there's been a number of legislative changes that have occurred. Going back to 2019 and 2020, there were changes to funding legislation for municipalities, trying to provide changes so that fees and charges would be a bit more transparent and predictable for developers, to sort of help them build affordable housing units, also to also provide for installment payments over multiple years, grandfathering in charges relative to times of planning applications as opposed to building permits, removing something referred to as bonus zoning and replacing it by a more broader average charging mechanism for high density dwellings. So these were things that have already occurred and already been implemented by the province to try to increase the amount of supply of affordability. And so Bill 23 is just sort of the next step in this overall plan. And so as I mentioned earlier, Bill 23, which is now received royal assent and is largely in effect. Some portions are going to be proclaimed later, but this is the More Homes Built Faster Act is what Bill 23 is. And that was introduced back in October, received royal assent on November the 28th. So moved through the legislative process pretty diligently. And again, this is in response to the More Homes Built Faster Ontario Housing Supply Action Plan, in that group that had prepared that document. And so again, the overall intent here is, how is the province going to establish this long-term housing supply options for Ontarians and their associated families, and with the goal of achieving this 1.5 million additional homes over 10 years. And there's sort of a few prongs that this is aimed at. One is reducing municipal costs to development. So presumably by trying to incentivize affordable housing, knowing that affordable housing by its nature is going to be challenged from a sort of margin perspective, trying to create additional margin by reducing those costs to maybe bring more of that to market. Also trying to permit more affordable housing by promoting increased density, something you refer to as sort of general density within existing established areas that have available services. Also trying to promote density near transit areas to sort of economize on those investments. And then also providing some other protections for home buyers, and also potentially utilizing provincial lands to build more attainable housing. So those are sort of the general themes. And then when you look at the bill itself, so the bill is an omnibus bill, right? So it amends, I think, about 9 or 10 statutes as part of the act. And so in doing so, some of the things, like I'm going to focus more on the financial aspects, but it's more comprehensive than that, right? So it identifies, as we talked about, the municipal housing targets. It also talks about or makes changes in terms of limitations on inclusionary zoning. So inclusionary zoning is that municipalities can require a certain amount of affordable units to be constructed within developments. They've limited that to no more than 5%. As part of these changes, they provided for, again, as of right zoning and permissions for this gentle intensification, where you can have up to 3 units per lot where existing services are available. So instead of having to go through those, you'll have those as of right. So again, to hopefully promote more of that. And again, I think that's important when you're trying to identify the affordable market.
So this is just, you could see within the GTA or within essentially in existing housing structures could create a 3-unit within their dwelling, could turn it into a 3-unit dwelling without any application for permission, essentially, for a permit.
Yeah, like you'll still have to go through the whole permitting process, especially around building construction and occupancy. But the the ability to start to get those units into the market is going to be a lot easier than having to go through the previously regulatory hurdles. And so to your point, Anthony, like when you look at Toronto, where you and I live, now starting to see more of these laneway units, for example, right? We're even seeing this in some of the census data around household formation, where you're starting to see more multi-generational families in dwelling units, right? So this may be in the form of, it's not necessarily additional units on the lot that are detached. It could be separate basement apartments. It could be laneway units. It could be, granny flats or units above detached garages, for example. So I think this is, one of the things that they've done by providing additional changes to the legislation to permit these types of developments more freely and easily. Also, with approvals around something referred to as site plan control, right, where they're now exempting residential buildings that contain no more than 10 units from site plan control. So trying to remove some of these, regulatory approval barriers that municipalities are required to go through this process with applicants to make sure that they're conforming to legislation, right? So making it a bit easier and quicker to bring them to market potentially. That also, there's another side to that too, right? What's the quality of what's being built if it's not, going through these processes as well? So it's not, on one hand, it should provide some quicker response and bringing those units to market, but we don't necessarily know what implications that may have, right, in terms of what is being built. Another aspect, which is fairly significant, is they're seeking to what they call streamline municipal planning responsibilities. So a lot of municipalities outside of Toronto, whether that's in Durham Region, Halton, Peel, York, for example, is a two-tier government. So you have an area municipal government, you have a regional government. And those regional governments have a planning responsibility as well. A lot of times, particularly identifying where growth is going to be located within the area municipalities and coordinating the broader servicing. And so they're looking to eliminate that upper tier planning responsibility, right? And so that, again, will have some questions in terms of what implications that may have in terms of coordinating servicing, allocations of growth within broader regional markets and so forth. So that's all part of the bill as well. And also looking to align sort of housing policy between, as I referred to earlier, the provincial policy statement and places to grow. So those are all part of Bill 23. So again, it's rather comprehensive in its intent. And then the area that I'm most focused on is what does it mean financially to municipalities, and particularly as it relates to the amendments that they're putting in place with respect to the revenue capability municipalities have to recover these costs of development. And so there's generally three major areas of funding that municipalities have to have growth pay for growth. And maybe just to unpack that statement a bit. So this province has a long history of having growth pay for their cost or their increase in demand for cost of service of capital. And the premise behind this is, if you think about it, for yourself personally, right? You have an existing home, you pay taxes for the services that you're provided. You have sufficient water and sewer capacity, you have sufficient road capacity to accommodate your transportation movements, you have sufficient parks and recreation and library facilities to meet your demands for those services. And those services are all provided out of infrastructure or facilities, right? So the premise of growth pays for growth is that as you add population growth or employment-related demands on your system, and they need additional infrastructure to support them, then that should be paid for by those new developments. That should not be a cost to existing taxpayers who already have a sufficient level of service, right? And so going back, to the 80s, and when municipalities were using something called lot levies, that was replaced by the Development Charges Act in the late 80s, and then subsequently revised in the late 90s. And we've had this mechanism in place that is very thorough. It's quite a methodology that's prescribed, that has to be followed, that has to be reviewed periodically every 5 years, now potentially every 10 years. and requires municipalities to do an extensive review of what that level of service is, cost those infrastructure items, and come up with a calculated charge that these developers have to pay for that cost obligation. So this isn't a tax in the sense of a broad ranging service that's being recovered from them. It's a very specific capital attribution based on their demands for service that's being identified. And so that's what's referred to as the development charges. In addition to that, and so the development charges are only a mechanism to fund capital costs of infrastructure relative to their need. And these can be appealed. And I've had to defend these in appeals many times that these individuals have the ability to appeal to determine that they're appropriately calculated. Another tool that's been in existence for a long time is something called parkland dedication, right? Where as you're adding additional development, they need additional land to support parks, to accommodate potentially recreational facilities, for example. This is another tool that you can use to recover those costs directly from developments as opposed to general tax base. And then more recently, as I was referring to previously, where there was high density development, where applicants were coming forward with an increase in zoning permissions to add floors to a tower, for example, municipalities could negotiate something called community benefits. That's now been replaced from a applicant by applicant agreement to a broader charging mechanism called community benefit charges, right? And this is only applicable for those high density buildings. So those are the three major mechanisms that are addressed in Bill 23, or the More Homes Built Faster Act. And firstly, what it does is it says, if you are building affordable housing, attainable housing, not-for-profit housing, or additional residential units, you no longer have to pay these charges, right? All three of them. And to put that, in some context, that you're probably looking at in, major GT areas, costs in the neighborhood of 120,000 per unit in that range, right?
Per unit? That would just be the development fee per unit?
Yeah, and DC is comprising probably the biggest share of that.
But not if you're building like a 400 unit or 200 unit condo structure.
No, I mean, even in those condo structures, it won't be that high because it's based on the underlying occupancy of the units. So it'll be less than that, but still going to be in the probably $80,000-$100,000 range.
Wow.
When you factor in all of these various charges that they would have.
So then it comes down to what is affordable. What is affordable? What is the three characteristics that you mentioned?
Yeah, and so the intent is that by absolving them of these payments, then again, are we creating more margin to potentially bring more of them to market? The definition of affordable, though, is being established as 80% of the average market sale price or average market rent. So some question, depending on where you live, is that still deemed affordable relative to income levels? They've put forward something referred to as attainable. We don't know what that is yet. We know that attainable cannot be an affordable unit. It cannot be a purpose-built rental unit. They can prescribe what will be attainable. So there's a bit of an unknown there that municipalities have to plan for. And then not-for-profit housing, and then the additional residential units. That's that gentle intensification that I was referring to. So if at your house, if you want to now add a basement apartment, add a laneway unit, for example, those are going to be exempt from payments as well. In addition to that, what they're also doing under the Development Charges Act is that if there's purpose-built rental housing, so this is high-density residential buildings for rental purposes for the entire building, they're going to receive a reduction in the development charge depending on the number of bedrooms in the unit. And so that's going to be a further reduction in that revenue. And so to me, those two are very targeted in the sense that I understand them in the sense of the plan, that they relate to promoting additional, what we call affordable or attainable housing, right, across the spectrum of ownership and rental. Some of the other things that they've added in here, though, which seem a bit misaligned with that, is what they're now requiring is that if I do a study for a municipality, and based on that infrastructure and the rules that are required, we determine a certain charge. And that's what you need to fund this infrastructure. They're providing a mandatory phase-in of that charge where you can only collect 80% of that total amount in year one, 85 in year two, 90% in year three, 95 in year four. So you cannot impose the actual charge you need until year five. And so that is going to be a reduction in revenues to municipalities as well. Also, municipalities, one of the eligible services that they were able to charge for was something called housing. So if municipalities wanted to invest in affordable housing projects and provide those funds, some of the cost of that grant or that funding that they would provide was being collected through development charges. That's no longer eligible. So now that all has to come from the tax base in that respect. And then also another significant adjustment is, in addition to collecting the infrastructure costs in DCs, you were also able to collect the costs of studies. So if you think about it conceptually, I'm a municipality, I have an official plan, this is how we're going to grow, this is the implication on services. I need to break that down to say, okay, what does that mean to my road network? What's my plan in terms of the specific infrastructure requirements that's going to entail? Then from that, you develop capital budgets and programs, and then DCs is a funding source in part for those demands. Now that they're saying is, well, you can fund the infrastructure, but you can't fund the study that determines the infrastructure. So now, all the studies that municipalities have to do to inform these costs are now going to be tax supported or supported through utility rates. So those are the major sort of specific reductions. And what this means for municipalities is because municipalities have very limited funding mechanisms, that if you can't use these tools that you're empowered to use through the Development Charges Act or through the Planning Act, where these applicants are deriving these benefits, you still have to put the infrastructure in place to accommodate these demands of your service. And if you don't charge them through these other mechanisms, the default is property taxes.
Right.
And so what ends up happening is you get a shift of that funding obligation moving from the cost of development for the demands that they're placing on your system to now being harmonized with the needs of your broader municipal services for your existing taxpayers, right? And so it's just a cross-subsidization of those needs, right? Where now, the question will be, does that present potentially a housing affordability challenge for existing homeowners as opposed to new homeowners, right? So this is the whole thing from my perspective. It's looking at, if we have an issue of housing affordability and we're trying to address housing affordability potentially by discounting fees and charges on new development, all you're really doing is shifting that cost to existing development. And so when does that start to pose an affordability challenge for existing residents and existing homeowners?
So it's interesting. The cross-subsidization you're talking about. So build back better, or build back faster, the homes. So that's fine. More homes built faster by reducing the development fees. But that means we already have a strained development approval process, because the people that are working there, as you mentioned, they could be retiring, they could just be less experienced. They're going to need more of those people because there's more applications hopefully coming, because you're saying we need a 50% increase in new approvals, right? From even what we've had over the last couple of years. And so that could mean that for those of us that already have a home, our property tax bill could go higher. And if I add to that the fact that the property, the municipalities make money from property tax on transactions, and we have transactions that are down 40% plus on a year-over-year basis, the cities aren't making fees on those transactions anymore. So the municipalities are faced with a huge problem, Plus, they have to support the transportation, the TTC, the GO. That's supported also by the municipality, and the ridership on Toronto on the TTC is 40% of, or what, 50% of what it was.
Yeah.
I'm making you laugh because you know all these things as well. And we had Joe Barrage. I don't know if you know him, but he's an urban planner with lots of experience, and he talked about some of these issues without even mentioning the stuff you've just gotten into. Just adds more to the whole pressure. So as we try to kind of pull, sorry, just to pull this together, and you're probably going to get this in your pitch here, but just so then, therefore, do you think this is going to work at the end of the day? You know, you read articles and it's all about, oh, the green belt is going to go away, and we're getting rid of land that should never have been gotten rid of. And is that really the issue when you look at all the key points you've mentioned? And I'll leave it to you to pull it together.
Yeah, so thanks. I mean, I think that there's definitely some challenges, and I think what it ultimately boils down to is that we commonly have these discussions in undertaking this work with the development community, where they're saying, if we end up increasing these development charges or these capital charges based on their infrastructure demands, then that's an added cost to the house of pricing, and that's going to further jeopardize affordability. So I think the real question here is that, are housing prices established simply based on input costs, right? Because I think that's, one question here is that, if these development fees are being reduced by $100,000 or $150,000 a unit, is that going to see a corresponding reduction in the housing price? Or is the housing price being established based on other factors like a strong labor market, interest rates, quality of life aspects, what you're bringing to market, and so forth, and you're going to charge what the market will bear? Now, some of my colleagues on the other side of the aisle that work for the development community say, well, but having that additional or that lower cost and that potentially additional margin is going to bring some of these developments that have been on the sidelines now potentially to market, because before the economics weren't there. Now maybe this brings them to market, right? And so if you think about that, if that's largely targeted at those affordable units that have lower margins, and now by reducing municipal fees and charges, that's going to be able to bring them to market to now be charged at those affordable rates, then that's a good thing, obviously. The question I would have, though, is, what does any of that have to do with expansion of urban boundaries and then opening up the greenbelt? Because presumably what's going to make those developments potentially more affordable is locating them in existing built-up areas and existing urban areas that aren't going to have additional, what we call sort of local service costs related to them, right? So I think, there are some things that are going to be beneficial in terms of starting to meet that objective of the 1.5 million additional homes, but it's really going to be on the margin here of, is this reduction in municipal fees and charges material enough to bring the additional supply to market? And obviously that's going to bear out as we move forward, because again, this is just one area of cost pressure. It's those other things you've talked about, right? The availability of labor market, the cost of labor, the supply chain aspects, the inflation environment, the interest rate environment. Those are all compounding implications here, right? So we've got to figure that out. My bigger concern, again, when I look at it more from a municipal perspective, is, so just to give you some numbers, so just with these changes of Bill 23 that, again, only relate to these capital charges of DCs, CBCs, and Parkland.
Yep.
The Association of Municipalities of Ontario, commonly referred to as AMO, said that's going to cost municipalities in this province about $5 billion over the next 10 years, right? So that revenue loss alone, which is about a little over, 550 million a year, is going to be about a 2.3% tax hit, all other things being equal, right? That's just those capital. What you talked about earlier was now, okay, now what we also need to do is we need to be able to ramp up our ability to process applications and permits by 50%. So let's first find the people to provide the supply of labor to do that. But then they have their own fees. Those fees of those individuals that are providing those services directly to the benefit of these applicants that are going to turn around and make market on those approvals. Yep. That gets paid for by planning fees and building permit fees and engineering fees, right? There's another piece of legislation that was adopted, Bill 109, which now says that if municipalities don't process those applications in an appropriate turnaround time, they're going to have to refund the money, right? And so, you know, I did recently a study with the city of Toronto. It cost them $80 million a year to just process planning applications, not even building permits and engineering fees and the rest. Wow. And if they can't meet turnaround times and they have to refund that money, that's an added cost that, again, doesn't come from a user fee, has to fall to the tax base, right? So that's an added pressure. And then again, let's even, you know, span out further here. Municipalities changed accounting standards in the early 2000s to account for tangible capital assets. They never had to do that before. Oh. Now they have asset management plans that are regulated, that they submit them to be able to continue to have gas tax funding. Those plans had to be submitted back in July of this year, which says we have all this built infrastructure that was built post-World War II that's now starting to come to the end of its useful life, that we're not getting senior level of government funding directly to fund anymore like it was when it was initially in place. This now falls to municipalities, right? So we got to replace the water mains and the sewer mains and repair the roads and build, you know, the storm infrastructure, right? So you've got that added cost that's already going to occur to existing taxpayers absent any cross-subsidization for growth. And then to make the story even worse, now let's factor in climate change. Right? Municipalities represent 2/3 of infrastructure, right? And we get more severe climate events, more flooding, right? These issues, that has an impact on infrastructure as well, right? So is that speeding up useful life cycles and so forth that we would otherwise had more time to plan for and to fund? So the way I sort of look at this, Anthony, is that, you know, on its face, Bill 23 does have some things I think that are going to be helpful to make sure that we can add additional supply, principally at that affordable level, to make sure we've got a sustainable economy dealing with some of the demographic challenges that we have. Yeah. But when you start to look at, you know, how those cost implications are going to be funded, marry them with the other challenges that our municipalities are facing, I think there's a real impact on existing homeowners and what those taxes are going to look like going forward.
Yeah, I'm sweating because as we're sitting here, what we can expect, it seems like, is property taxes going on, and because there's no other source of funding unless now at the provincial and perhaps even federal government level they say, yes, okay, you want all these people to come here, you don't want us to charge the developers to do the planning input and so forth, to make sure that that development happens, and you want us to do it within a time limit. I get it, but unless you give us some funding, don't send us any more people, because we have nowhere to put them.
Well, and that, you know, that's, you know, in part, especially like I was referring to earlier, when you start to look outside of the greater Golden Horseshoe area, these relatively smaller communities that have now had a bit of an influx in population, who now have to say, oh, wait a minute, we need to expand our treatment plants. We need to extend our water and sewer mains. We need to widen our roads. Now you've cut back on some of those funding, that funding availability, and it's going to go to taxpayers. You know, existing taxpayers vote, right? So that's going to, you know, present some local issues. And so again, I think just in summary, what it means is I think either, you know, municipalities who have limited funding tools available to them, I think it's either or a combination of both, either higher taxes and higher water, sewer, utility fees, and maybe introduction of storm fees, for example, to pay for some of these costs, or a reduction in level of service, right? Where more congestion, right? less available parklands, less available levels of service that maybe existing residents are used to and accustomed to. So some combination or balance of that's what councils are going to be struggling with, unless that can be assisted, to your point correctly, from senior level government support, whether that comes from the federal or the provincial government. And so it's important because, again, we all need to make sure that we have a strong and vibrant economy that's going to support us going forward. And, so this level of housing demand is going to be required.
Andrew, as we, continue to move forward here in the current economic environment, it seems every expert taxes go higher. There's no magic here to pay for the things that need to get done. Listen, in the interest of time, if anyone has any questions, please feel free to ask. I've just launched a poll here. You can tell us what a great job Andrew has done, and if you have any suggestions for future ideas of things we could cover. Andrew, I guess you've given us sort of the end conclusion on where you see this, or what potential the impacts are. Is there anything we've missed that as we just wrap up, and most, I think, of the listeners here already own homes or some type of dwelling? What are the things that so if you kind of wrap this up for us?
Yeah, again, I mean, I think it's just a sort of broader indication of what we're seeing around public goods more generally. And so, a more informed electorate, a more participatory electorate, I think, is important in terms of understanding these implications and making sure that people are doing their democratic role in that process. And I think that's probably the best that we can do. Again, there's obviously a lot more depth you can go into all of these things, but hopefully this was informative to sort of sketch it out at a higher level. Thanks very much.
Two last quick things we always like to ask our guests: favorite podcast?
Other than this one, a big fan of Tim Ferriss.
Okay, and favorite book?
As you and I know, we exchange books pretty much every Christmas, and
Yes.
Big fan of Stoicism. Daily Stoics, probably the one I come back to all the time. Looking for your copy?
Yeah, it's got to be. You know what? It's got to be in my bedroom. Yeah, it's in my bedroom. I like the one you gave me that has the leather bound. Okay, Andrew, all the best. Thank you. Just so much. It's amazing that I love having the experts on, because we just see how complex what seems like a very simple idea. Hey, we're just going to build more homes. Look how easy. We'll just take out some of the screen land, and don't worry, we'll get the new homes. Anyway, Andrew, we'll check in with you as this develops sometime next year, and see what the implications have been. Thanks.
Thanks, Anthony. Pleasure.
Thanks, everyone.